Is Fastly stock making a comeback? Should you hold on if you still have shares at a higher price? We're going to talk about that and more today. What is going on, investors? Hopefully, you guys had a wonderful day out there. It's time to talk about Fastly Incorporated, ticker symbol FSLY. I remember the last time we covered this company about 3 months ago. It was a really funny video. And look, the stock has rebounded nicely down at the $40 level and is now closer to about $55 per share. In fact, the stock was up big today, 8%, and we're seeing follow through in the after hours after the company reported earnings that were higher year over year and did beat on a revenue and an earning per share basis. Talk about that along with the Q4 guidance as well. We have to get into these numbers. We'll take a look at them. We'll see if it makes sense of a stock that right now is worth $6 billion. Yeah, $6 billion on this one. Now, unfortunately, for anybody that's holding Fastly stock for any length of time, stock's down over the last year 24%. Year to date, even worse, down 43%. You really had to time buying this stock at the correct time to make money on it. I would bet, in fact, the vast majority of people have owned this stock at a higher price. Now, what has came in after the bell that is sending the price higher and maybe saving some people from deep losses on this stock is revenue came in at $87 million in the most recent quarter, Q3. That is good for 22.5% year over year revenue growth. And some people might say, hey, that's really good. I just did a series of video on FANG where the lowest growth was 16% at Amazon and the highest was at 40 some odd percent, and that was from Google, and all of the companies fell within that line. And if you want to throw in a Tesla on top of that, well, now you're talking about close to 90% growth year over year. So when people talk about these high flying stocks, these overhyped stocks that are growing at just 22% unprofitably, I'll remind you, we'll take a look at the financials here in a second. This company is losing money. They're taking on more debt over the last 9 months, and revenues are only growing at 22%. I know some of you are going to say it's a little unfair to compare Fastly to FANG, but my dollar that goes into Fastly is exactly the same as the dollar I would have invested in a FANG stock. I'll have you answer that question next time you want to buy a stock like this. Q4 guidance came in at $90 to $93 million. The consensus was closer to $94 million, but shareholders, at least at the current time, are giving Fastly a pass on that one. Now, let's come over these numbers here. This revenue came in at $86 million. Again, this is 20 some odd percent higher than we were a 3-year period. At least Fastly has turned around. I think the last quarter we did, they actually declined on revenues. They've got them growing in the right direction, going from 70 up to 86. For the last 9 months, they went from 208 to 256. And I want to remind you that they are guiding between $90 and $93 million in the next quarter, and that's in terms of revenue. So for the full 12 months, we'll just give Fastly the benefit of doubt of $100 million. We'll factor in maybe they land a big customer and they put a bunch of revenue on board this coming quarter, which I don't think they'll be able to do, but that would put them at $350 million worth of revenue. $350 million worth of revenue, and we've got a $6 billion valuation and climbing on this one. I'll let you do the math on a price to sales basis on that and compare that to any stock that you want to. Some that might be profitable, paying dividends, and even buying back the shares. Talk about that more here in a second. Now, in terms of research and development costs, sales and marketing, and general and administrative, we did see those tick up quite a bit over the last year. They went from $64 million all the way up to $100 million in the most recent quarter. In fact, this company over the last 9 months has been right at that $100 million run rate on those operating expenses. That gives us a loss from operations, because when you only gross $45 million off $86 million worth of revenue, and then you spend another $100 million operating the business, that means you have a loss from operations at $55 million. I'll remind you, this stock has a $6 billion valuation on it as well. The $54 million is about what we've been losing over the previous quarters as well, since for the last 9 months, we've lost nearly 3 times that at $162 million. You got to pay some interest and some other taxes. All things being considered, this company is bleeding money out the door. Now, in terms of the balance sheet, paints a slightly different picture. Come here up to cash and cash equivalents and marketable securities. We had about $190 million at the beginning of the year. Now we got like $600 million. So you better believe none of that money came from actually running the business, since that was negative. We'll see more of where that money came from in a second. In fact, here it is. Long-term debt over the last last year, the company, oh yeah, that's $932 million worth of debt that this company had to put onto its balance sheet. And when you look at the financials of this company, that doesn't appear that they're going to be profitable anytime soon. Chances are they're probably going to need some of that money. Now, some of you might argue, well, maybe the company is cash flow positive. That's where they're printing some of this cash. Well, let's take a look at the cash flows, pull down this net loss number. We've got our 3 months ended here. We pulled down that $56 million. We lost only $23 million the year before. For the last 9 months, we've tripled, more than tripled our net loss. It went from $50 million up to this $165 million. Now, FSLY is generously rewarding stock-based compensation employees, executives over at FSLY. Notice last year they did $12 million worth of stock-based compensation. Yeah, that went up 3 times to $36 million. I think over the last year on this stock, can you see that executives earned 3 times more stock-based compensation, considering the stock is nowhere near its all-time highs, up well north of $125 per share on this stock? I would argue that maybe investors are being bamboozled to a certain degree. Now, for the last 9 months, you've ponied out $100 million worth of stock-based compensation, and that is nearly 3 times higher than what they did last year. Now, even with those we're talking about absolutely egregious stock-based compensation numbers. These are ridiculous. But on cash flows, we get to add that back in, because that's not physical cash flowing out of the company. The company is still cash flow negative. Okay, so we are just rewarding executives who have this stock trading at $54 when earlier this year it was at $120. So these executives are getting boatloads of shares basically in stock-based compensation, and they're still cash flow negative. They're still operating profit negative. It's just an absolute disaster. In fact, we were at a positive based on those fantastic cash flows that we get from stock-based compensation. We actually were cash flow positive on a quarterly basis and a 9-month basis last year, and we've turned that negative over the last quarter and over the last 9 months over at FSLY. I have absolutely no idea what the board of directors or the shareholders of this company are doing, letting the company do this. Now, they bolted on this $930 million worth of debt. They used another $680 million worth of cash in financing activities. Investing activities, purchasing lots of property and plant and equipment. You see, last year they purchased $11 million. Now that's all the way up to $20 million. Over the last 9 months, we spent $31 million versus $23 million in the previous period. I'm not opposed to companies investing in their business. This company is burning through cash, and that is why they had to bolt on nearly $1 billion worth of debt over the last 9 months, because these executives are lighting money on fire when you look at these financials. Now, when you look at this from a technical perspective, not all that bad. Okay, we've basically, now, I'm sure most of you have probably bought this stock much higher than this. I mean, this stock was, holy cow, it was up here at $136 per share. I mean, this stock was way higher, and I would guess the vast majority of people that have held on through this downtrend really bought it there. Now, there has been some technical areas where you could have bought this stock over the last 9 months or year or so, is down here at this 39 level. In fact, we've bounced recently off this 39 level, and now we're up here at 55. Am I really excited about it being up here at 55? No, it really would have to get through this $60 level. That's really where I would want to get this one. If you don't own FSLY and for some reason you want an unprofitable, richly valued from a price to sale. I mean, we can't even look at price to earnings on a company like this, but from just a price to sales perspective on mediocre revenue growth on a company like this, I mean, 22%, that's really mediocre, especially when you compare it to mega capped stocks that pay dividends, that buy back shares, are wildly profitable and not nearly as overvalued from a price to sales perspective as FSLY. I don't necessarily know why you would want this stock in your portfolio, but let's just say you did. I personally would wait for it to get over $60 per share. I know that doesn't make a lot of sense to especially newer investors, and this is something that I had developed over time as an investor and here's the perfect example. So we could have bought this stock back in June for $55 $60 per share, thinking, hey, it's going to come up here to $60 and we're going to be feeling really good and maybe we'll break through 60. Well, if you didn't put your sell in order here at 60, stock came all the way down to $40. And so quite frankly, I'm expecting the same thing to happen with FSLY. This stock get up here to 55. Quite frankly, wouldn't surprise me if very soon, maybe even in the next week or two, this stock's all the way back up here to $60, maybe even a little higher than that, all the way up to $61, $62 per share. Wouldn't surprise me one bit if that's what happens to this stock. But now you're bolting on even more money to this rich valuation onto this unprofitable stock. Not only that, executives are very, very well compensated from a share-based compensation perspective, and I guarantee you they're absolutely unloading those shares so they can buy their next Rolex or their next boat or their next vacation for their family. I would fully expect this stock to go from 60 quite frankly, back down to 40 and retest $40 because that's what it's been doing over the last few months. And I would wait for that trend to reverse itself before, quite frankly, I'd want to step in and buy this stock. That was FSLY. Interesting stock, interesting company, but actually a pretty bad stock and a pretty bad investment, especially when you compare it to many, many stocks, not to mention the aforementioned FANG stocks, considering this stock down year to date 43% and over the last year 24%. Man, you could have been in hundreds of other investments and actually made good return on your money. Your money has been locked up in a poorly run company, and I think you should think about that as an investor going forward. That was FSLY. Hopefully you guys enjoyed this one.